Hello, everyone, and welcome to the CEO and Market Expert Interviews. I'm your host, Lucian. Some of you know me as Triangle Investor from X or former Twitter. Today, I'm joined by Justin Huhn, the Uranium Insider. Justin, as always, great to have you, and thank you for coming.
My pleasure. Always good to see you as well, Lucian.
Thanks. Justin, when I prepare questions for interviews, I always combine my questions with the questions sent to me by my followers. And that mix we will have today also. I want to start with the question, I have to laugh. The question that's sent to me by my seven followers. That question is when moon for
When
uranium?
moon. I knew that was coming.
Yeah.
I don't know when moon. I think I don't really bet on this sector based on an expected moonshot. It's really a long-term outlook for me. So I'm perfectly happy making higher highs, higher lows for as long as this investment lasts. With all of that said, I think that there will be a point within the next, let's say, 12 to 24 months where we'll see a situation where the demand will significantly outstrip, in that moment in time, available supply, and we'll probably see the price move pretty significantly. Of course, at any point, if we have a substantial inflow of capital into the sector and specifically into the funds, we see yellow cake and SPUT get closer to NAV or actually breach NAV and go to a premium. That'll be a major signal that the sector is about to go on a very, very strong run. And interestingly enough, in sort of the first time, really, I don't want to say in history because I think this happened a little bit in the previous bull market, but certainly not to this extent. The physical market participants are watching the equities very closely. So they're recognizing, okay, when SPUT's at a 15% discount to NAV, like it was at yesterday's close, there's really no urgency to top up. Let's say if a fuel buyer needed a few £100,000 just to bolster inventories and they could go into the spot market to do it, there's no real urgency to do that because they don't feel that there will be any significant financial impact on the spot market in any sort of real time near term. So, but if you start to see the equities move up and you see capital flowing in and SPUT gets to a 10% and 5%, 3%, 2% discount, then you'll start to actually see some front running of that move in the physical market, and you'll see traders picking up in the spot market. So in many ways now we're actually seeing the physical market move in conjunction with the equities, which is sort of a new phenomenon. But
Yeah.
when moon, I don't know when moon. I do believe we will see a moonshot type of move at some point. That could happen because of financial influence on the sector. It could happen simply based on the demand that's out there that you can easily model out and the available supply in the next few years. So
Yeah.
I would say when we'll see a big move in the next couple of years, I believe, and probably sooner.
Yeah, agreed on that, definitely. Justin, what are you hearing and seeing about the activities on both sellers and buyers on the spot market at the moment?
It's extremely quiet. It's basically dead. So this move down from just north of $100 down to where we're at today, which is like $93 a pound. That move down, it has been basically triggered by essentially a single trader that is selling a very, very small amount of pounds into a very quiet market. It's utterly noise. It's literally not affecting anything in the term market. The term market is strong at significantly higher prices, especially when you're talking about market reference contracts that are being signed by producers currently much, much higher. So this move down in spot literally has been triggered by a trader, maybe two, with offtakes, primarily one trader that has an offtake on a monthly basis from a producer. And the forward month that they will have to pay to this producer is priced at the month-end price. So when they offered up a few £100,000 into a market where there was essentially a short-term kind of buyer's strike, it's very, very quiet. The price drops. They keep dropping their price until somebody grabs it. So that's basically what's happening in the spot market. It's extremely quiet. The term market, on the other hand, is starting to heat up. There's multiple relatively large RFPs in the market right now. There's a lot of off-market discussions. There's a major meeting happening this week between a large uranium trading entity that also brokers term contracts, meeting with over 25 United States based fuel buyers. That's happening this week. So there's a lot of interest. There's a lot of concern, I would say, or the concern is starting to build. And this move down in equities and in spot right now is basically just everybody kind of digesting the enormous move that the sector just had. Perfectly normal, perfectly healthy to see a stepping back, an assessment of the move, both for equities and for spot, before we figure out where this base is and then go from there. So that's kind of where we're at right now. And interestingly, the equities have actually outperformed the metal on this pullback. So the metal has dropped, like 12, 13%, something like that. URA is down about 10%. So it's very, very interesting to see that.
Yeah, definitely. You mentioned RFPs. What's your take for 2024? Some numbers. Do you have approximate idea of the quantity of RFPs in 2024?
Well, there's a really big one in the market right now. If it's 21 million pounds for delivery over 14 years, all the way out to the end of the next decade. So that's a large RFP, and we're going to see more and more of these large contracts. And every time we do, what that does is it essentially sends a message to all of the fuel buyers for all of the utilities globally that this particular entity is stepping up and saying, okay, we accept this pricing environment and we're going all in. We're going to make sure that we cover our needs. Doesn't matter the price, we're going to do it. And that's ultimately the reality for every utility. When they buy what they need to buy when they need to buy it. There's not a lot of timing in the market. Yes, the spot market has its fluctuations, but as far as signing term contracts, that's essentially done when it's needed at whatever price the market is pricing in. So right now we've got almost 11 million pounds signed in the long-term market this year so far, a little bit slower than last year. Last year we had some big contracts in Q1 between Cameco and Energoatom that got the year off to a big start. But we're expecting it to heat up. We can already see that there's a lot of discussions and RFPs happening in the term market that should get signed in the next number of weeks. That's going to continue to build that momentum. We're just going through a short pause period after a doubling of the uranium price. I think that's something that everybody needs to consider when a commodity doubles in price, that you have to sort of understand that multiple players, both on the investing side and the physical market side, are going to step back and say, okay, that escalated quickly. Let's let this settle out for a second, see what really the market pricing is here, and then we'll go from there. And that's kind of what we're seeing right now. There's nothing to suggest to us that this is even remotely close to being over. There's so much demand going forward in the term contracting market, and such little supply that's available right now.
Yes, good point. Just quick return on the spot market. How important is the spot market for you? I mean, traders play a larger role in the smaller spot market, according to Mike Alkin. He sees the spot market as mostly market of uranium traders with small balance sheets selling pounds among each other, among themselves. I'm somewhere in the middle here, maybe more on the Mike side. What's your take?
No, he's absolutely right. But it also does matter. It's, more and more of these contracts are primarily, if not entirely, exposed to market reference.
Yeah.
So at the point of delivery going forward, we're still seeing contracts now that are being delivered on now that were signed years ago that have at least partially fixed prices at much, much lower prices, which is why all the producers have been flexed up on by their utility customers. But going forward, these contracts are signed mostly, if not entirely, market reference. What is market reference? The spot price at the time of delivery. It matters, and it matters a lot. But the moves up and down in the spot market, you have to understand why they're happening and who's doing the buying and selling. That's really, really important. So that's what our focus is. So if you see the price went to 107, 108, pulled back to down to 93, yeah, you might say, okay, that's a 12, 13% pullback, whatever it is. That's big. Why is this happening? Is there a problem here? And you understand, oh, that's based on 500,000 pounds being sold in a thin market by a trader. It's like, oh, well, that doesn't really mean anything. At the same time, it's the most visible price that's updated daily that investors can watch. So it matters a lot in that respect, because that's what everybody's watching. And you might say, okay, well, we saw the price pull back. That might be vindicating of a move, whether you took profits on the previous run up or you think it's going to pull back, the equity is going to pull back, and you're like, oh, see, the spot price is following. See, it's not indicative of anything fundamental in the physical market right now. It's not. But it is important because A, contracts that are market reference rely on that price at the time of delivery, and B, it's what all the investors watch. So it matters, but Mike Alkin is absolutely correct. And his company, his fund, they're buyers of physical, and they're in there in the physical market, and that gives them a lot of insight into what's actually going on in the physical market. So you should listen to him when he speaks about the spot market. He knows exactly what's happening there, and almost all of the volume is pounds being traded back and forth. This is a historically extremely volatile move in the spot market, going from the 50s to over $100 in 4.5 months. Traders love this market. They love this volatility. And so we're going to see pounds traded back and forth. That's 80% of the volume in the spot market. It's not a market where utilities go for reliable supply. That's just not how it works.
Yeah, every time I speak with Mike, he always says that spot market is a bullshit market. That's his take. Okay.
Yeah.
Yeah.
Yeah,
Let's.
it doesn't mean a lot in terms of procurement for actual end users, but it does matter. It's not irrelevant. Obviously, investors watch it, and that's, a lot of times you'll see the spot market fall $1 or $2 and people start selling their positions, not necessarily because they think the trade is over, but because they think that other people will do the same thing.
Exactly. Yeah. Justin, let's talk more numbers. Update on the uranium supply demand imbalance. How is 2024 looking, and further 2025, 2026? Can you tell me more?
We have the imbalance this year somewhere around 40 million pounds of a shortfall in supply, which is a lot. Going forward, it gets a little bit better, but not that much better next year, the year after. But demand continues to rise. We're seeing life extensions across the board in the United States. We're seeing life extensions in Canada. We're seeing life extensions in the UK. We're seeing life extensions in Belgium. We're seeing restarts in Japan.
Yeah.
We're seeing massive new builds in China. They just reiterated they wanted to be, oh gosh, what was the number off the top of my head? It was like a 5 or 6x of their existing program by 2060.
Yeah.
But even they're still realistically going to be able to build 6 to 8 reactors per year. As far out into the future as we can see right now, they're reiterating that plan. There was an article that went out yesterday about this, and there was some really important language in that article referring to China, which was security, energy security, and 2060. Okay, so they think in decades, and their priority is energy security. It's not profitability of buying and selling uranium. So that's going to be their focus. Of course, there's multiple Chinese entities. Yes, they're all essentially state-owned corporations, but they don't all act in concert. So to say China is doing this and China is doing that is not always necessarily an accurate statement, but their growth rate is impressive. And at 6 to 8 reactors a year, by the time 10 years from now, 2035, if they hit their target, they're going to be consuming 75 million pounds of uranium per year. That's 50% of global supply right now. And that's just China. They're going to surpass the US, which is the largest nuclear market in the world. They're going to surpass that by 2030. But to go back to the numbers, we're seeing the gears start to turn on the supply side, right? We're seeing some supply start to respond. There's US ISR projects that are actually producing a small amount of yellowcake right now. Boss restarted Honeymoon. Cameco brought MacArthur back online. They're bringing Cigar back up. We see Kazatomprom saying they're going to increase production. Everybody is trying to increase production right now, and some of them are going to do it. And every year we're going to see, another small 1 million or 2 million pound project come online or restart, and that's going to happen year over year. And until we get to next gen's Rook One, Arrow Deposit, Denison's Phoenix, Kazatomprom's Ramp, until we get there, we're not going to come close to a balanced market. And there's a lot of factors that you can't model out. Primarily, that would be secondary demand. So secondary demand is, financials and inventory builds primarily. So the financials are a very difficult one. We know they're going to be buying something. Since Sput and Yellowcake have been in such a big discount so persistently, we've seen more hedge fund activity actually buying physical uranium. That's been happening a little bit. There's been a little bit of trading, buying and selling, but on balance, more buying. And then secondary demand in terms of inventory rebuilds is also something that's very difficult to predict. You can go back in time and look at historical inventory levels. We're not in panic levels of inventory, but historically speaking, we're at 2004, 2005 levels of average nuclear utility inventory. And they did restock into a rising price environment in the previous cycle. Will that happen precisely like it did last time again this time? I don't know.
Yeah.
But there's going to be some inventory restocking that's above and beyond the run rate requirements for uranium purchasing. With all that said, we have a very, very different market in terms of secondary supply. So that was secondary demand, right? Hard to model. Financials, inventory building. You can plug in 5 or 10 million pounds a year, whatever it might be. Could be much, much more than that, depending on how aggressive nuclear utilities get in terms of their restocking, and and that's going to be based on how concerned they are about supply. And we're moving slowly in that direction. Secondary supply, on the other hand, is very, very different from the previous market. So during the previous bull market, let's say 04 to 07, and then again, in the years prior to that and following that, we had 24 million pounds a year from megatons to megawatts, right? That's the largest mine in the world, essentially, secondary supply, buffering the primary supply during that entire market. Then we also had enrichment underfeeding. We still have that now, primarily coming from Russia. In the previous bull market, that was a much, much higher number. That was probably 20 to 25 million pounds of uranium on top of the downblending coming from megatons and megawatts. So you had a secondary supply of 40 to 50 million pounds a year. We're nowhere near that right now, okay? Western enrichers are not underfeeding. There's no underfeeding. And underfeeding basically is having excess capacity. You can spin the centrifuges down to lower tails assay, and you use less material than was provided to you by your utility customers. You sell that excess material in the market. You underfeed the centrifuge and sell that material. You can also, with excess capacity, re-enrich depleted tails. That's something that Russians were doing a lot in the previous market. So Western enrichers not underfeeding, 10 million pounds a year secondary supply gone. So we can probably figure 15 million pounds of secondary supply coming from underfeeding and tails re-enrichment. That's it. There's there other secondary supply coming from inventory being sold into the market? Yes, there is, but that's also double counting because that was counted as supply when it came out of the ground. So it's not really fair to call inventory drawdown or inventory sales as secondary supply, even though it effectively acts like it. But it's a very, very large supply deficit this year, roughly 40 million pounds, with a qualifier that we don't know how much secondary demand there's going to be. It's much easier to model out secondary supply. So it's 40 million plus.
Yeah, that's a great breakdown. I'm reading that World Nuclear Association forecasts supply deficit may be too conservative. Would you agree on that?
Definitely, yeah, I think so. And they're obviously going to take a very stable sort of conservative look at the market, right? They're not going to say we expect spot to buy this much, we expect hedge funds to buy this much. So the secondary demand numbers are going to not be included at all in that type of forecast, whether that's inventory restocking or financial buying. So yes, generally speaking, and there's also very difficult numbers. This sector is so hard to model out in some ways because you can look at a snapshot of supply and demand for any specific year, and that gives you an idea about the structural supply and demand picture, but it doesn't really tell you how much buying and selling is going to be happening in that given year, right? Because nuclear utilities, like I just said, there's an RFP going out to 2039. So what does a 40 million pound deficit in 2024 or a 20 million pound deficit in 2027, what does that mean if the utility is buying out into the end of this next decade? It doesn't really mean that much. The buying patterns and the momentum of the contracting cycle is going to dictate price more so than this structural supply deficit. A deficit matters. It's important to recognize when we will see a quote unquote balanced market, because that's going to affect the spot market. It's going to affect term contract pricing, et cetera. But considering this environment where we're seeing all of these new builds being announced, all of these life extensions, and a handful of restarts in an environment where we could see 200 to 300 million pounds of demand of uranium from SMRs that haven't even been built yet going out for the next 10 years. There's all of these different potential X factors that could significantly move this market. And then with all of that said, Lucian, you have to make a certain assumption about enrichment tails in order to get that demand number. And it can have huge fluctuations in both directions.
Yeah.
Right now, Western enrichers are their operational tails assay is in the mid 0.2s.
Yeah.
Okay. 2 years ago, it was at 0.2 or lower.
Yeah. Yeah.
It's moved up a lot. So that means if they're operating their centrifuges at a higher tails assay than what was signed in previous contracts, that's technically overfeeding. Although what they're telling the market is that they're not overfeeding.
Exactly.
Yeah.
Exactly.
One more point I'll make and we can move on. The transactional tails assays, in my opinion, is even more important than the operational. Why? Because if you are a utility and you're signing a contract for enrichment with Urenco from 2028 to 2035, and you're signing that contract at 0.3, which they are, 0.3 tails assay is 22% more uranium you have to purchase as a utility to feed into that contract than if you had signed it at 0.2. So all of these enrichment contracts with Western enrichers that the Western utilities are primarily signing with, right? Business with Russia in terms of new contracts has largely fallen off a cliff amongst their Western customer base. So these large contracts with very high tails assays mean a lot more uranium has to be purchased. So whenever you're making these supply and demand forecasts going out year over year over year, you have to plug in a tails assay assumption. And those tails assumptions probably are conservative coming from WNA and UXC. And I'm telling you,
Probably,
the
yes.
financial guys that we speak with that have been doing this for 10 years and they know this market inside out and backwards are making much higher tails assumptions in their models than the WNA or the UXC.
Yeah, I couldn't agree more on that, Justin. When it comes to contracting uranium, we have few approaches with players on the market, everyone with their own calculation, of course. We have conservative approach like Cameco, Uranium. Then we have contracting less conservative like Anchor Energy, Global Atomic. And then we have a third side, companies like that they're taking unhedged approach like UEC. What do you think? Who is the picking up the right market signals and have the right approach?
I think that everybody's aware of the market signals at this point. I don't think that there's any meaningful different take, although I would argue that some of the analysts and a handful of utilities still believe that this market is relatively balanced and there's not going to be any problems securing supply. And that's okay. That makes a market, right? You have to understand the historical context. The structure of the physical market right now is different than it's ever been in their careers. We've never, ever seen a market like this where there's barely any secondary supply. We've got a supply deficit and an incredibly robust and encouraging environment for the growth of nuclear globally, underpinning the entire thing, a full-on nuclear renaissance right now. So this is a new environment. So I don't really have a problem with people that are, or the players in this market are like, everything's fine. Okay, that's fine. It makes a market. As far as the types of contracts being signed by the different players, it really depends on a lot of different factors. One is the level of development of that particular entity, whether they're producing, whether they're developing, whether they're just getting their initial financing. That has a lot of influence on terms. But also there's some elements to this market that have nothing to do with simply making a bet on the nature of the physical market and trying to squeeze as much profit out of it. So I know for a fact there's deals done relatively frequently where price is not the bottom line.
Yeah.
So in some cases, you'll actually see deals being done that are done with elements to those deals that are encouraging of the relationship between the buyer and the seller.
Mm-hmm.
So basically one entity throwing the other a bone in order to shore up that relationship. I know for a fact this is happening. This was shared with me recently by a physical uranium trader, basically, that they had brokered a deal between two entities and the deal was at the set price. And at the time of delivery, and the price went up by the time the delivery was supposed to happen. And the seller honored the lower price, even though they didn't have to. And they said, well, not everything's about money. Sometimes it's about relationships.
Okay.
So there's element, these contracts are very complex. And unless you know the exact details between the buyer and seller, it's hard to really say, oh, this company is doing right and this company is doing it wrong. You can make a comparison between let's say Cameco and Kazatomprom, right? You can actually see their like a sensitivity table to the actual spot price at time of delivery and how it affects their bottom line. Kazatomprom seems to have more exposure to that. So how do you read into that? Well, the contracts that were signed that are being delivered into now, Cameco probably signed earlier. They probably signed more longer term contracts. Kazatomprom likely signed more shorter term contracts, 3 to 5 years, and Cameco probably was 5 to 7, 8. And so that has a lag time and has a lagged effect. Contracts Cameco is signing now are extraordinarily profitable for the company, but it's not going to pay out for the next, until 5 years from now. Just how it just moves very, very slowly. And they're a company that had to survive with a huge mine on care and maintenance and hundreds of employees, with a higher mining cost than Kazatomprom. Whereas you compare and you say, oh, look, NextGen hasn't signed any contracts or Boss hasn't signed any contracts. Well, if you're Boss and you're coming in the market and you're going to maybe produce 500,000 pounds this year and you have a de-risked project and you're cashed up, you don't need to sign, contracts and at fixed prices, right? So it has a lot to do with the risk of production actually coming to fruition for a developing company. There's just so many factors. It's hard to really say, oh, these people are doing it right, these people are doing it wrong.
Yeah, I agree. There are really a lot of factors here. Justin, how much of enriched uranium does Iran have and impact if that material gets to the market? We saw the news today where US urges Iran to dilute all its near weapon grade uranium, but the question is, will that happen? If that material goes to the market, what is the impact, possible impact?
That's a really good question. I actually don't know the answer to that. I need to look into that. Yeah, I'm not sure.
Okay.
I mean, historically speaking, I can't say that Iran selling enriched uranium has had any effect on the market whatsoever. And I would sort of fade any concern about that.
Okay.
That's my knee-jerk reaction. Yeah.
No problem. What about impact on the market if we see a scenario where Chinese and Russian enrichment had a delay or they are canceled?
Chinese or Russian, you mean like if it's actually sanctioned officially for the United States?
Yeah, and that.
Well, I don't know about canceled. I mean, China is building out their own fuel cycle, so they're going to continue to build out their own conversion and enrichment for their own needs. They do sell some material. They trade material here and there. They have for as long as we've been following this market. So the Chinese selling material here and there is not unprecedented. With that said, the recent news of the Chinese selling some EUP to Russia has nothing to do with the U3O8 market. So China, on balance, is a buyer of uranium. They've been the most aggressive buyer of U3O8 in the past 18 months, bar none. They've signed 2 gigantic contracts with Kazatomprom that should have been a wake-up call to the West in the biggest way possible. For whatever reason, it really hasn't been, but it will be. So they're securing more uranium through long-term contracts. And what I understand is they are kicking the tires, especially in Africa right now, looking at more projects. So with the size of their build-out program and the seeming seriousness of that build-out program, they're going to be net buyers. Russia, same thing. Russia. So both the Chinese and the Russians, who had been marginal spot market sellers of U3O8 for as long as we've been following the market, both of them turned to buyers last year. Now, everybody's buying. Nobody wants to sell. The only people selling here are traders in the spot market, period. So everybody else is buying. And of course, the producers who are largely selling have also been buying a little bit of material here and there in the spot market. So Russia has a very large nuclear export program. They have 18 reactors under construction around the world right now. They're short on uranium. They don't have a lot of domestic production. Their best assets by far are their joint ventures with Kazatomprom. Yeah. But they obviously have a lot of conversion and enrichment. So they are going to continue to enrich and sell that enrichment to everybody else who's going to buy it. If the West is going to boycott that material, at least with new business, they've still been delivering to the West, to Europe, to the United States, to everybody. All these legacy contracts have been honored. They've never missed a delivery ever in their history of nuclear fuel services. So they've been historically extremely reliable.
Yeah.
Prior to this whole mess in Ukraine, you talk to fuel buyers, even in the United States, they're like, we absolutely love doing business with the Russians. I place one phone call, I get my uranium, my conversion, my enrichment, my fuel fabrication, and it's done. And I get the best price in the market. Like it was perfect. It was brilliant. Well, now that that's relatively off the table, that's also a major element that's influencing this sort of new normal in this uranium market. Whether or not that material is going to be officially sanctioned in the United States with the legislation that's on the table right now, I don't know. I do think that it will be. This bill that passed I think it passed the House and now it's being held up in the Senate. It's being held up by a single senator, Senator Cruz from Texas, for whatever reason. He's got his own personal agenda. It's pretty annoying. We're already hearing that the elements in that bill that have to do with banning Russian uranium, they're trying to move that into a different bill.
Yeah.
So I think it'll pass because the industry is supporting it now, which is very, very interesting. Yes, there's a few utilities that are more near term in need of that material if it does get sanctioned officially, but they will have waivers according to this bill. I think it does happen. Now, the big question is if and when it happens, what will Russia's response be? We're effectively, when I say we, the United States is effectively in a proxy war with Russia, considering all of the money and weaponry that's being given to Ukraine that's fighting Russia. So this is wartime. It really is. There's no other way to put it. So if we decide to sanction that material, is Russia just going to go, screw you? We're not going to send it to you anymore. That's a possibility. And I'm not just throwing this out there. This is what is being messaged to the nuclear utilities in the United States by UXC, by TradeTech, by the people that are following this market and making more judgments on the political influence of this market. That's a possibility. So certainly the market's aware of it. Market doesn't seem to be pricing in any near-term concern of that material being cut off right now. But that could change. So one of the reasons also with this Chinese delivery of EUP to the United States, most of that apparently happened at the end of last year, following the House passing that bill. So we believe that to the extent that the reporting on this is accurate, which it's coming from an anti-nuclear organization that hasn't really been all that accurate in the past, assuming if we give them the benefit of the doubt and say, okay, yes, the U.S. did import all this Chinese EUP, which is less than 5% or 10% of their annual needs. That probably was in response to a concern about that material being cut off after that bill was passed through the House. And they said, okay, shoot, if this gets cut off, we need to make sure we're shored up. So, but you also have to look at the net effect of that. What happened November, December, January in the physical market? EUP was up, SWU was up, uranium was up $15 a pound. So for the people that are panicking over 10% of the United States needs being purchased and being delivered into by China and saying, why are the Chinese selling? Stop lumping them into as the Chinese. Maybe they were able to buy some cheap EUP from elsewhere. Maybe it was Russia. This article is insinuating that there was a swap, that the US is buying extra Russian uranium by moving it through China. No, that's illegal. That's illegal in the United States. There is point of origin throughout the fuel cycle. So that's something that I would call out in that article. But either way, if material does get officially cut off, whether from the sanctions or Russian actually saying we're not going to send it to you anymore, we will see a very, very large reaction in the uranium market to that.
Yeah.
I'm not betting on it. I'm not hoping for it, but that's what would happen.
What about Cameco? What is next for Cameco? How do you think they will position themselves in the upcoming period? I mean, when it comes to a few things, buying on the spot, ramping production, give us your general opinion on Cameco going forward.
I don't think Cameco needs to buy in the spot market. That's my overall take. They make it very confusing though, because they list their committed purchases from their Inkai joint venture and other producers that are purchase commitments.
Yeah.
That's effectively their production, right? Though that's not buying in the market. They did in this most recent conference call say that they could potentially have to buy up to 2 million pounds in the spot market this year. They have inventories they can draw on. They can borrow pounds. I think they're going to avoid doing that unless we see the spot market drop even further. They'll probably be in there. Right around this price level is where it's kind of like their balance point. Above these prices, they stand to lose money because when they buy in the spot market, deliver into partially spot reference contracts in the past that have the partial fixed at a much lower price. So if the price drops below this even more, they'll probably be in the market buying because they're in the money at that point. But I don't think they need to do a lot of buying. they seem to be positioning themselves as kind of a vertically integrated company. And I think it's really brilliant. And I'm loving watching it, honestly. I think there's immense growth potential for Westinghouse, which they are now a 49% owner of. Huge, huge growth potential, extraordinary moat. They have a incredible skilled staff and intellectual property value that you can't even put a price on. And to the extent that we are in the early stages of a nuclear renaissance, this could be an enormous growth driver for the company. On the uranium mining side, we've got Cigar, that phase one of Cigar is set to decline and end its production by the end of the decade. But they did say in the previous call they're going to be investing potentially $200 to $300 million to go into an extension of Cigar, which is effectively a Cigar phase two. My understanding is that Cigar phase two is more difficult mining, lower grades, slightly more complicated geochemistry. So it's going to be more difficult to maintain that nameplate, or at least more expensive. But I think they're going to make every effort to do it because of this incredibly robust demand environment. And I'm sure their phone is ringing off the hook right now from nuclear utilities. So they're going to continue to do that probably later this year, if not next year. We'll probably hear that they're going to restart Rabbit Lake in Saskatchewan. We're probably going to hear that they're going to restart their US ISR operations. How long those will take to get in development, it'll take some time. But I think they're going to try and shore up their supply as much as they can, especially considering Inkai has been impacted like the rest of Kazakhstan's projects. Not majorly impacted, but slowly in decline. The wellfield development hasn't been as much as it has been in previous years. More acid has been needed. Plus, you have the delivery complications. Cameco doesn't want to receive the material through the port of St. Petersburg, so they've been using the western route. They have received a delivery from that western route. It's much more expensive, takes way longer. So I think the company is going to do what they can to shore up their production in Canada, in the United States over the next few years. MacArthur is going to ramp. I think they pulled that off. I'm more skeptical about Cigar's nameplate production, but MacArthur has the grades. It has the mine life. They'll be able to get to that nameplate mill capacity of 25 million pounds a year. It's going to take probably 3 to 5 years in order for them to go from 18 up to that level.
Yeah. When we are talking Canadian production, what project, which company do you see as the next producer in the Athabasca Basin? Do you see that Denison mine with the Wheeler River? Do you see Fission or NextGen? Who will be the first, in your opinion, among those three?
Oh, I think it's going to be Denison. Yeah. Even though ISR in the basin is new and therefore is going through a regulatory process that's has some new elements to it, it's an ISR mine. Yeah. It's going to be able to produce faster than building an underground mine, for sure. That's my bet, anyways.
Okay, but do you see Fission and NextGen projects come online before the end of the decade, 2030?
I think so. I think the price incentive is there. I think it's there. And if you had to look at developing mines in the previous decade, you were developing into a price declining environment. Right now, every single signal, whether it's the growth of nuclear, whether it's the supply deficit and the robust price for uranium, everything is pointing towards let's get this done. So I think they're going to do what they can to bring that online. Will they be able to produce in the timelines that are stated by the companies? Probably not, but that's not unique to those companies. That's every single company doesn't hit their on time, on budget in terms of uranium production. It's just how the mining world works, especially for uranium. I should also say, though, in the basin, as far as new projects, I think we could potentially see some other new projects come online even before Denison. Maybe it'll be a tough call, but Denison and Orano have a technology called Sabre.
Oh, you mean
surface access borehole recovery, where you basically drill a hole down to the actual deposit. Then it's this rotational kind of jet boring, and you can extract the slurry from that jet boring through the same machinery that drilled the hole. It's pretty brilliant. They've been testing this in McLean. They're going to be producing 500,000 pounds in 2025 coming from McLean with Sabre. There's plenty of high grade deposits that are deeper than you can access by ISR, but not necessarily large enough to justify building an underground mine with freeze walls like Cigar and MacArthur River, like ISO's Hurricane, for example. That's what, 50 something million pounds at 35% uranium. That's screaming saber. So
Yeah.
we could see something like that happen possibly sooner than Denison, but Denison is checking all the boxes. I think we'll see Phoenix producing probably before any new project in the basin.
Oh, it will definitely be before Wheeler River project. I talked with David Cates from Denison, and he confirmed that it will be before, definitely. What about US, United States? How do you see production restarts there, and what new projects do you see there coming online first?
New projects. Well, most of everything that's happening in the United States is restarts or brownfield, right? So Encore just restarted Rosita and Alta Mesa. UEC, I believe, is coming back with Brook Hollow. URG is currently producing. Energy Fuels is currently producing a small amount. The ISR, and they're restarting White Mesa and some dry mines. ISO Energy has some dry mines in Utah, the Tony M and Daneros, that are underground mines. Those will be able to produce next year, a small amount, but they'll be able to produce next year.
Yeah.
Like I mentioned, Cameco, they haven't officially said that they're restarting their US stuff, but it'll probably happen. New projects in the US. Well, Encore's Dewey Burdock is one that's in the works. That's still quite a few years away, but that could happen. You have ISR projects in New Mexico also, some actually very good projects in New Mexico
Yeah.
with Laramide and Encore that has more of a social challenge, let's say, in that area, but fantastic deposits. Not a lot of new greenfield happening in the United States right now. There's a bunch of companies that have moose pasture that are starting to drill here and there, and they'll eventually, if we have the market that we think we will, eventually some of these projects will come online. But for now, it's mostly brownfield restarts in the United States.
Yeah, definitely. Justin, another question. One of my followers is asking, is it worth looking at other nuclear adjacent industries, not just uranium mining, pick and shovel type play, for example, sulfuric acid or power plant contractors with a strong hold on construction, or any other? If so, can you mention any names?
Well, we've seen recently the energy utilities in the United States have made huge moves, the stocks for these companies, for Constellation, for Vistra. And we've also seen companies like BWXT make very, very large moves, and they're involved in multiple aspects of not only the nuclear fuel cycle, but also products and services within the nuclear industry. So they've had a great move. I think, honestly, the picks and shovels is going to be in the SMR space. That's what I believe. And I think we're still so early with that because there's almost nothing you can invest in that space. GE Vernova, which is their SMR building segment of the company, is going to spin off an IPO. They're building the BWR RX300. That's, as far as I can tell, probably the most widely adopted small modular reactor in development right now around the world. They're building 4 of those units at the Darlington facility in Canada. There's multiple other countries in Europe that have signed letters of intent or MOUs with GE. That's one to watch. Then we have Oklo with Sam Altman's SPAC investing in that project. I think we're going to see multiple SMR projects and companies go public in the coming years. And I think that's the most exciting space that we're watching right now. So as far as the picks and shovels, there's not that many ways to play it. Even some of these companies that are building small modular reactors like GE, like Rolls-Royce, it's hard to have investment exposure by buying those companies to that tiny portion of their business. But that's going to grow. That's going to change. We're going to see probably some spin-offs. And so that's what we're watching. But as far as investing in picks and shovels right now, it's pretty difficult to get pure play sort of leveraged exposure to the nuclear elements of those businesses, with a few exceptions that I mentioned.
Mm-hmm. Final question, Justin, uranium equities and possible future performance. I mean, which category of uranium stocks could outperform next? Is it the developers, explorers, producers, or ETFs? What's your take?
Oh, I think it's time for the explorers and the developers. Yeah. I think there's already clear evidence that money's rotating that direction. Like, for example, URNJ, the Sprott Junior Uranium Miners ETF, right, which excludes Kazatomprom, Cameco, and Sput. All right, and it basically holds everything else, and it has a lower threshold for inclusion into the ETF in terms of market capitalization and liquidity requirements. That's already significantly starting to outperform Cameco, starting to outperform URNM and URA. We're seeing that move into the small and mid cap stocks. And of course, this is not like a wingnut theory. This happens in resource markets. The first legs of the markets are almost always led by the large caps. Why? Because they have liquidity sufficient for smart money to actually take positions. The sector is still so small. There's a lot of institutional interest in this sector right now. And if you're managing 500 million to $1 billion or more in AUM, you basically can't touch this sector with any meaningful size exposure. That's slowly changing, but I'm very bullish on the developers and of course the explorers. I think we've seen a couple of good exploration results over the past 12 months with both Canalaska and F3 making decent hits in the Athabasca, and the stocks obviously reacted to those discoveries. So certain explorers are going to have their turn here, and it's a tough game, man. If you are a small enough company that's exploring, you are not included in the ETFs, and you don't get to benefit from that flywheel effect from capital flows into the ETFs, and you have to dilute every time you drill. Even a small drill program is pretty dilutive and expensive if you have a small market cap. It's a tough game, man. So with explorers, we don't really like to gamble with drill plays. Personally, that's just me personally, right? But a diversified basket of explorers and developers, I think, is going to significantly outperform both the ETFs and the large cap stocks in the next leg.
So long story short, more ETF flows are on the horizon.
I think so. And I lost my train of thought there with URNJ. They have not seen a single day of redemptions. They're now at, I think they're pushing 400 million in AUM 1 year in. They started out with 3 million. They've seen nothing but inflows. But over this past, let's say 2 to 3 weeks, we've seen decently chunky outflows of URNM. At the same time, we're seeing inflows to URNJ. So I'm not saying people are selling URNM to buy URNJ, but there certainly is some rotation of money happening here.
Definitely. Ladies and gentlemen, this was Justin Huhn, aka Uranium Insider. Justin, thank you for coming to my show. It was a great chat as always, and let's catch up again soon.
It's always my pleasure, Lucian. Thank you again for having me.